In the last few months of trading, a statistical anomaly has emerged in the global precious metals market, one that is currently defying the standard models of global arbitrage. According to recent data from the Shanghai Gold Exchange and trade reports from Bloomberg, physical silver in China has been trading at a premium ranging from 10% to 15% over the spot price in New York and London. This is not a minor fluctuation. It is a persistent structural dislocation that has caught the attention of commodity researchers, logistics experts, and macro analysts. It suggests that the global price of silver is fracturing, driven by an insatiable appetite from the East that Western supply chains are struggling to satisfy. This specific development has led to aggressive price targets from technical analysts. But before we analyze the data, I must state clearly, this video is for educational and informational purposes only. I am not a financial advisor. All opinions shared are my own and based on publicly available information. Please do your own research before making any financial decisions. In this video, I'm documenting a pattern that has repeated across multiple commodity cycles in recorded history. We will examine the data behind the $63 price models, analyze the sovereign absorption framework, and determine if history is about to repeat itself. Commodity historians and market analysts have documented a recurring sequence that appears across multiple supply-demand crises throughout history. I call this the geographic arbitrage cycle, not as a prediction tool, but as an analytical framework for understanding how markets have historically responded when one region drains supply from another. It's important to note, markets can behave irrationally, timelines vary dramatically, and past patterns don't guarantee future outcomes. History doesn't repeat exactly, but as Mark Twain allegedly said, it often rhymes. Here's how analysts break down this specific pattern. The first stage is the sovereign divergence. This stage is characterized by a decoupling of prices. A sovereign entity or major economic zone begins bidding for physical material at a price significantly higher than the global benchmark. Key characteristics include high import volumes into the premium zone, rising basis spreads, and the initial confusion of market participants who view it as a temporary anomaly. The second stage is the vacuum effect. As the premium persists, it creates a gravitational pull. Traders and logistics firms begin buying metal in the discount market, usually the West, to ship it to the premium market in the East. This results in documented drawdowns in visible exchange inventories as metal is loaded out for export. The third stage is delivery stress. The inventory in the discount market reaches critical lows. The paper claims on that metal begin to exceed the available stock for immediate delivery. This is often marked by exchange rule changes, rising lease rates, and extreme volatility as industrial users panic buy to secure supply chains. The fourth stage is the repricing event. The price in the discount market is forced to snap up to meet the premium market to stop the hemorrhaging of inventory. This is usually a rapid, non-linear price appreciation, often followed by regulatory intervention or a market reset. Now, I'm going to walk you through two documented historical cases where this pattern emerged, specifically involving the Hunt brothers in 1980 and the Russian palladium squeeze of 2000. Then, we will examine current data from China to see if similar conditions are present today. Let's look at our first case study, the Hunt brothers and the 1980 silver squeeze. To understand the mechanics of a physical squeeze, we must look at the most famous example in modern history, the Hunt brothers' accumulation of silver in 1979 and 1980. While popular culture often remembers this as a story of greed, from an analytical perspective, it is a textbook example of sovereign-scale accumulation overwhelming the paper derivatives market. According to historical records from the Commodity Futures Trading Commission and Stephen Fay's detailed account in Beyond Greed, here's how the situation developed through our framework. In the accumulation phase, Nelson Bunker Hunt and William Herbert Hunt began accumulating silver when they believed inflation was destroying the purchasing power of the US dollar. Between 1973 and 1978, the price of silver drifted from roughly $2.90 to $6. Unlike typical speculators, the Hunts did not just hold futures contracts, they took physical delivery. They moved bullion to Switzerland and Texas, removing the float from the market. By 1979, they had established a partnership with Middle Eastern investors to continue the buying. By the summer of 1979, the vacuum effect took hold. The sheer volume of physical metal leaving the COMEX and Chicago Board of Trade created a vacuum. As the hunt stood for delivery, the short side of the market, primarily large bullion banks, realized they did not have the metal to deliver. In August 1979, silver was trading at $9. By December 1979, it had crossed $20. The vacuum had sucked the available liquidity out of the vaults. The delivery stress phase is critical to our analysis of China today. Contemporary observers noted that the basis had flipped. Usually, futures prices are higher than spot prices. But in late 1979, the market went into backwardation. Spot silver was more expensive than future silver because buyers needed it now. On January 17, 1980, the price hit $50 per ounce. New York Times archives from that week reported that jewelry shops were paying people cash for silverware on the spot to melt it down. The industrial supply chain for film and electronics was breaking. The resolution came not through market equilibrium, but through intervention. On January 21, 1980, the COMEX changed the rules. They announced Silver Rule 7, which restricted trading to liquidation only. This meant traders could no longer buy new positions. They could only sell existing ones. With the buyers legally removed from the market, the price collapsed. By March 1980, the price had fallen from $50 back down to under $11. This historical case demonstrates how physical removal of the asset drives price discovery, not the paper derivatives, until the rules of the game are changed. It documents that when available float near zero, price becomes nonlinear. Now let's move to our second case study, the Russian palladium squeeze. This case is perhaps more relevant to the current China situation because it involves a sovereign entity and industrial necessity rather than financial speculation. According to Johnson Matthey Historical Market Reports and USGS Mineral Commodity Summaries, here is what happened in the late 90s. First, the divergence began. Russia controlled roughly 50 to 60% of the world's palladium supply. In 1997 and 1998, administrative delays in Russian export quotas disrupted the flow of metal to the West. Simultaneously, automobile manufacturers like Ford and GM were increasing demand for palladium in catalytic converters. A structural deficit was forming, but the price remained dormant in the $150 to $200 range. The market assumed the Russian supply would eventually flood back in. By 1999, realizing supply was unreliable, industrial users began to panic. This wasn't about profit, it was about survival. Ford Motor Company, fearing they couldn't finish building cars without the metal, began aggressively buying physical palladium to stockpile. They weren't speculating, they were securing supply chains. This created a geographic arbitrage, where metal in vaults was claimed by industrial users, leaving speculators holding empty paper contracts. The price of palladium went from roughly $300 an ounce in 1999 to an all-time high of $1,100 an ounce in January 2001. Lease rates skyrocketed to over 100%. This implies that owning the metal now was infinitely more valuable than owning a promise for metal later. Ford accumulated a massive stockpile near the top of the market, driven by the fear of zero supply. So how did the palladium squeeze resolve? The price eventually crashed, falling back to $300. The high price did its job. First, demand destruction occurred as automakers re-engineered their catalytic converters to use platinum instead of palladium. Second, the high prices eventually loosened the Russian bureaucratic hold, and supply resumed. The consequence was that Ford wrote off over $1 billion on the value of their palladium stockpile. When we compare the Hunt brothers and the palladium squeeze, several similarities emerge. Both experienced a disconnect where physical scarcity trumped paper pricing. Both saw exponential price moves in Stage 3. However, the Hunt brothers case was financial speculation, while palladium was industrial necessity. This industrial necessity driver of the palladium squeeze is specifically what analysts are comparing to China's current solar demand. Before we examine the current data from China, it's important to consider opposing perspectives. Not all analysts agree that a silver squeeze is imminent. First, consider the recession thesis. Some analysts argue that a global recession will crush industrial demand for silver. Major investment bank reports often cite slowing manufacturing PMIs as a bearish signal. The argument is that if global factories slow down, they need less silver for electronics and alloys. However, data from Bloomberg NEF shows that green energy demand has historically decoupled from general GDP growth, suggesting specific sectors can grow even during broad recessions due to government mandates. Second, consider the hidden inventory argument. Economists point out that there is massive above-ground silver in the form of jewelry and silverware. They argue that if prices rise, grandma's silverware gets melted down, flooding the market with recycled supply. While true, refining capacity is a bottleneck. Data shows there is a lag time of 6 to 18 months between price spikes and scrap supply hitting the market. These counter-arguments deserve serious consideration. Markets are complex, adaptive systems. The pattern I'm documenting isn't guaranteed to play out identically. What I'm presenting is pattern-based scenario analysis, not inevitable prophecy. Let's now examine current conditions through this lens while maintaining appropriate skepticism. Now let's examine recent data to see if similar conditions to our historical cases are present today. Remember, similar conditions don't guarantee similar outcomes. The first critical indicator is the Shanghai Premium. Current data from the Shanghai Gold Exchange and CME Group highlights the geographic arbitrage. Throughout late 2024 and 2025, silver in Shanghai has traded between 10% and 15% higher than the international spot price. For example, when silver is $30 in New York, it is effectively $33 or $34 in Shanghai. According to customs data cited by the Silver Institute, China has been a net importer of silver, absorbing significant tonnage from global markets. This spread creates a risk-free profit for anyone who can buy silver in London, fly it to Shanghai, and sell it. This acts as a giant vacuum cleaner on Western vaults. Next, we look at inventory drawdowns. According to CME Group daily warehouse reports and LBMA vault data, the vacuum effect is verifiable. The registered category of silver, metal available for immediate delivery to settle contracts, has dropped significantly from its 2021 highs of nearly 150 million ounces to levels often hovering below 30 to 40 million ounces. London vaults, which underpin the global ETF market, have seen consistent outflows. Some researchers interpret this as the drain phase. Others argue it is simply just-in-time inventory management. However, the correlation between the Shanghai Premium and the London drain is statistically significant. The third factor is the solar shock. Recent reports from the International Energy Agency and Bloomberg NEF illuminate the demand side. Solar photovoltaic production is consuming a much larger percentage of annual silver mining supply than previously modeled. In 2023 alone, PV demand exceeded 190 million ounces. Furthermore, the industry is moving to TOPCon and HJT solar cells, which use 20 to 50% more silver per panel than older technologies. Since China produces over 80% of the world's solar panels, their demand is inelastic, much like Ford's demand for palladium in 2000. Based solely on pattern comparison, current conditions show strong alignment with the pre-acceleration phases of both the 1980 and 2000 case studies. This suggests the possibility, not certainty, that the market is primed for a repricing event where the Western price must rise to close the gap with Shanghai. Analysts examining these supply-demand dislocations have modeled several potential scenarios regarding the $63 target often mentioned. The first scenario is historical pattern continuation. If conditions develop similarly to the 1970s or Palladium 2000, the COMEX price could be forced to rise to close the gap with Shanghai. Technical analysts note that breaking the $30 and $50 resistance levels often invites momentum trading. The $63 target is a technical extension level often cited by chartists if the all-time high of $50 is breached with volume. The second scenario is the deflationary dampener. Alternatively, recessionary forces win out. Global manufacturing contracts and solar subsidies are cut, and the premium in Shanghai collapses as Chinese internal demand cools. In this scenario, silver remains range-bound between $20 and $30. The third scenario is the unobtainium market. This is a bifurcation where physical silver becomes difficult to source without paying massive premiums over spot, while the paper price on the COMEX might stay low. For those studying these dynamics, here is how professional analysts typically structure their monitoring. First, monitor the Shanghai premium by watching the spread between the Shanghai Gold Exchange and the COMEX. If the premium expands, the drain on Western vaults likely continues. Second, watch vault depletion rates using CME Group warehouse reports. Specifically, watch the registered category versus eligible. Rapid drops in registered often precede volatility. Third, watch solar installation velocity using global gigawatt installation numbers. If solar growth accelerates despite economic headwinds, the silver deficit likely deepens. For those wanting to study these topics further, you can research the Silver Institute's annual World Silver Surveys, the Shanghai Gold Exchange Daily Trading Reports, and the U.S. Geological Survey Mineral Commodity Summaries. This framework is for educational research only. No one can predict market outcomes with certainty. Past patterns provide context, not blueprints. Anyone considering financial decisions should consult with licensed professionals. We've examined the geographic arbitrage pattern, looked at the Hunt brothers and palladium historical precedents, and analyzed the current data coming out of China regarding solar demand and premiums. The key analytical findings are that China is paying a premium for silver, creating an arbitrage incentive that drains Western supply. Western vault inventories have shown a corresponding decline, and industrial demand from solar is altering the fundamental supply-demand balance in a way that resembles the palladium squeeze of the late 90s. However, markets are unpredictable. A global recession could invalidate the industrial shortage thesis, and timing is inherently uncertain. I create this content to document patterns and facilitate informed discussion, not to provide financial advice or predict the future. I'm a researcher, not a financial advisor. If you found this analysis valuable, consider conducting your own research using the sources mentioned. What is your perspective on the China demand factor? Do you think the industrial demand is strong enough to counter a recession? Let me know in the comments. I read and learn from the discussion. Thank you for engaging with historical pattern analysis. Until next time, stay curious and stay informed.